Where it comes to sentiment, Eric, it feels as though investors are still trading the thematic, and the one thematic they have to trade is AI. So in the context where they don't have all the clues they want around monetary policy, they keep going in one direction towards AI stocks. Would you agree with that?
That's right. I mean, we had a really strong Q1 earnings season, and perhaps now the market has gone from focusing from AI to EI, employment and inflation going forward. So perhaps there's the one bit that can derail that strong performance that we've seen over the past month. It's true that the market came from a very weak performance in April, so some of that has been a rebound. And when you look at some of the earnings that we're seeing, is just beat everywhere that you look at. And it's fair to say that there are reasons to be optimistic. There are reasons to believe that some of those earnings are really hard to predict, to the point that markets are providing valuations to those companies that seem unbelievable until then they come and deliver. So that is very much the confusion, I would say, in markets at the moment, that you have to contrast that very strong sentiment from earnings to perhaps the more hawkish rhetoric that's coming from the Fed at the moment.
So, Eric, let me put my words into your mouth, your words. Then basically, a vast amount of this market, let's just say, for sake of argument, 9 out of 10 stocks are valued the wrong price because they're valued on the growth scenario we're seeing, as you and Karen mentioned, out of AI, which has shown proven revenue and profit potential at the Nvidias of this world. But there are other companies who can't possibly match those kind of profitability spectrum levels that we're going to see from Nvidia, and yet are still getting the benefit of the doubt. That leaves a lot of this market trading on thin air.
That's right. I mean, when we look at valuations across the market, we are seeing forward-looking Ps of around 20 times, which when you compare against the current real yields for the 10-year, that's standing at 2.1%, I believe, at the moment. So those valuations are not consistent with the current level of real yields. So unless we see a massive dovish tilt from the Fed, those valuations won't make sense. At the same time, we need to continue delivering on those earnings in the quarters coming forward. So it is true that the market is becoming extremely demanding, and proof of that is the fact that although we had better than expected earnings for Q1, the price reaction wasn't that great. When you look at the underlying data, the price reaction for some of those beats actually didn't perform as expected.